What's up, investing legends? Today we welcome Gian Pazzia to the program. Gian is the co-founder at KBKG, one of the largest cost segregation firms in the country. And in today's episode, we dive deep into all things cost segregation, depreciation, and tax strategy. We kick off the episode with Gian giving a detailed overview of cost segregation, depreciation, and bonus depreciation, and how all these things tie in together and why they are so important for real estate investors to understand and utilize. Later on in the episode, Gian goes into detail into how these big time investors, millionaires, use cost segregation to bring down their taxable income to zero or basically zero. And finally, to conclude the episode, Gian and I spent some time talking about how residential real estate owners, like short-term rental owners, can leverage these cost segregation studies at a fraction of the cost using cost segregation software that he launched in 2016. And we also spent some time talking about the short-term rental loophole and how owners of short-term rentals can use real estate depreciation to offset ordinary income. Lots of really interesting and technical secrets shared in this episode. But if you're obsessed with tax strategy or even remotely curious as to how your investment strategy can help you save money, massive savings on your tax bill, this episode is for you. So without further ado, everyone, let's welcome to the program, Gian Pazzia.
Welcome to the Investing Secrets Podcast.
Gian, welcome to the Investing Secrets Podcast.
So glad to be here, Danny.
Yeah, man, you ready to step inside the vault with me?
I'm ready as long as what goes in the vault stays in the vault.
Yeah, exactly. Yeah. What goes in, stays in. Love it, man. Well, we've never really had a cost segregation expert on this show before. So I would like to, and I want the audience that's savvy here to bear with me. But for those that don't know what cost seg is or think they know, but don't really know exactly what cost segregation is, could you just define cost segregation and some of the benefits maybe of performing a cost segregation study?
Sure. Yeah, I'll break it down. Cost segregation is a way for real estate investors to basically minimize their tax by speeding up how fast they're going to write off parts of their building through tax depreciation. So normally for tax purposes, you're supposed to write off your building over 27 and a half or 39 years, depending on what type of building it is. And so residential properties get a 27 and a half year life. Commercial properties, 39 years. But not everything in the building lasts that long. And so going back 50 years to the way they designed the tax code, they're essentially allowing you to write off certain things in the building quicker that really aren't considered structural parts of the building, right? And so we're talking about, let's say it's a residential rental property. We're talking about things like the vinyl plank flooring or maybe cabinetry in the laundry room or even appliances in the kitchens and the wiring and the piping that support the appliances. If you go outside the building, things like the asphalt driveways, right? These things, everything I just listed, can be written off much quicker than the building itself. And so a cost seg study normally is done by an engineer that goes out to the property, that surveys it, measures, counts, takes a catalog of everything that's in the building, and they break it into all the different pieces for tax purposes. And you get to write off a ton of that in year one. Okay, so you get these bigger tax deductions by doing a cost segregation study instead of spreading those out over decades. And so let's kind of use some numbers here to bring it home. I'm just going to talk about a small residential rental property, right? That someone may have bought for $300,000. So step one for tax, right? Your CPA or tax preparer, you have to separate the land from the building value, because land, when you buy a property, you don't get to write off, because that goes up in value. But the building, it depreciates, right? So let's say in my example here, $300,000 property, 30,000 of that we'll call the land value. 270,000 of that is the building and improvements. That's what you get to write off. So you have $270,000, And without a cost seg study, you're going to get to write off $10,000 each year for 27 years. Okay. Now, with the cost seg study, you can get as much as 25% of that building number and write it off in year one. So now we're talking about 25% of 270. That's $54,000 of deductions compared to the $10,000 with a cost seg study. So now you're just increase your tax deductions by almost 4.5 times. So that's the power of the cost seg study, is you're accelerating your deductions. You're writing off as much of that building as fast as possible. And so it's a time value of money play. It's don't pay your taxes earlier, hold on to that money, reinvest that money into more properties that could be working for you.
Yeah, and it used to be, right, Gian, that the cost seg study would break things down into, it's 3, 5, and 7 years, right? Typically is like some of the
3,
lifespans.
5, 7, 15.
Okay.
Yeah.
So lots of like odd numbers, right? Like it's just like, I don't know that there's any even numbers, right? I just know it's 3, 5, 7. And so, but then there's this concept of bonus depreciation, right?
That's right.
And bonus depreciation, can you explain that for the audience?
Yeah. So bonus depreciation is an incentive that first came into place right after the 9/15 terrorist attack, when the economy kind of dipped. And basically what they're saying is anything that has a short tax life already, 3, 5, 7, 15, you're going to essentially get to write it off even quicker than that. And so right now, with the Trump tax bill, they increased the bonus depreciation rate to 100%. So what that means is that if we find, let's say, that $54,000 of stuff inside a $300,000 property, normally it would have been depreciated over 5, 7, or 15 years. Because of bonus depreciation, you get to write it all off in year one now. So it just means it's speeding it up even faster.
Yeah, it accelerates it, right? And so you get to capture all of those losses in one calendar year. So that sounds great. And that sounds like it could provide a tremendous amount of benefits. One thought that could come up, or I know, because like there's contrarians that are listening right now. Well, doesn't that just lessen the amount that I can deduct in future years?
That is absolutely correct. We're not magically creating deductions here. We're just taking the ones that would have been in the future, and we're taking them today. But as you know, in real estate, sophisticated financial folks, it's all about what you're doing with the money today. And so that's really where the power of cost seg comes in. Additionally, there are some other ways where you can, there's some other issues when you get into tax called recapture that we could talk about as well if you want to kind of go down that road. But to your point, this is all about taking deductions today, deferring taxes as far out as you can.
Yeah, 100%. And I was going to bring up recapture. So since you brought it up, I think we might as well talk about it now because we tease the audience. So, obviously, whenever we talk about depreciation, right, I think one of the biggest misconceptions is that this is like free money that the government's giving you, right? But it's not, because at some point, all of that depreciation gets recaptured at the end, whenever there's a liquidity event, right? Or typically, not liquidity event, like literally a sale, right? When there's a sale, not a refinance, but when there's a sale, that gets recaptured. So first of all, explain that, and then we can talk about ways to kind of offset that.
Sure. So basically, if you're going to take, let's say, $100,000 of accelerated deductions from your building doing cost segregation, in your, let's say your tax rate is 40%, right? So you're essentially saving $40,000 because you had $100,000, that's your tax rate. If you sold the property in year 8, let's say, for cash, normally if you bought the property for $1 million, and let's say you sold it for $1.5 million, okay? Everyone knows what capital gains are, right? The capital gain is how much you sold your property for minus how much you bought the property for. and you're taxed at a capital gain rate of 20% on that portion. Well, what we're talking about now is if you bought that property for $1 million and you accelerated 100,000 of that, your gain when you sell that property is really more than $500,000. It's actually 600,000, right? Because you accelerated a bunch of depreciation. So now you're going to pay your 20% on the $500,000. Well, there's a different tax rate you pay on the amount you depreciated, and that's the ordinary rate. So if your ordinary rate is 40% at the time, you're going to pay basically 40% tax on that $100,000 of depreciation gain, if you will. So you're essentially paying it back. You're getting it and you're paying it back. And we're bringing this back to the fact that you got to hold on to that money for that 8 years. And when you're talking about like, when we're getting into bigger properties, when you're talking about, $5 million, $10 million properties, I mean, the tax savings gets to be dramatic versus the cost. So it becomes a no-brainer to do this, even if you're going to have to pay recapture tax in a few years.
Yeah. So let's talk a little bit more about recapture tax, right? So you're taxed on the recapture at an ordinary income rate. However, how does this all play into, like, say, a 1031 exchange, right?
Yeah.
Like when we exchange into a property of equal or greater value.
Yeah.
What happens then?
Yeah, great question, and the perfect follow-up, because that recapture you pay if you're choosing to sell for cash, right? You're going to pay that recapture. That can be avoided if you do a 1031 exchange. So in any situation, if you're doing a 1031 exchange, that whole issue we just talked about is a non-issue. You continue to defer those cost segregation benefits, those tax savings.
So, and this is one of the things, one of the I think the key reasons why larger properties change hands so often. And I think this is one of the core reasons why, because at some point after the first couple of years, a lot of the tax savings starts to dry up, and then the deferred maintenance starts to add up too. So at some point there's a lot of things, you've got little incentive to hold on to the property. The tax incentives get wiped out and you get more and more things that need to get taken care of. So you say, hey, wouldn't it just be better if I exchange into an equal or value of equal or great property of equal or greater value? And then I'll let the next guy take care of these issues. And then they get all the tax savings because they're the new owner, right?
That's right. And if you exchange, then you're getting more basis, usually because you're trading up, and you get to continue, claiming more and more depreciation.
100%. And this is why, coming from the hotel world as well, this is why hotels change hands. One of the reasons why hotels change hands so frequently is every 7 to 10 years, the brand mandates a PIP, property improvement plan. You've got to go in there and do millions and millions of dollars of renovations. And it's like, hey, why am I going to, I'm just going to go buy a bigger hotel because I won the game of Monopoly. I'll go buy a bigger one, and I'll, let some other guy come in here and take care of all these renovations. And by the way, then they're getting a bunch of write-offs at the beginning too, because they're doing all this renovation, and all the entire PIP really gets accelerated, or a lot of it gets accelerated kind of into that first year. So it's interesting, right? Like how when you think about the tax incentives and how that drives the market. And I think it's important for people to understand, right, Gian, I'm sure that you could comment on this, is that these sorts of things actually keep the market healthy, because, it helps things stay fresh. It helps incentivize owners to invest into their properties, right? These are tax advantages that ultimately, and maybe you could speak to that.
Yeah, look, I've been in the cost seg world for over 25 years and got a ton of clients, big, small, some of the biggest clients in the world to do real estate, and some smaller ones. What I can tell you from working with all those clients and CPAs that service those clients is that the tax code is slanted towards real estate owners, meaning if you play your cards right, you can literally pay no tax if this is your business, right? And there's some kind of rules that you have to qualify for to be considered a real estate professional. But, guys like Donald Trump, right? He doesn't want to show his tax return because he's not paying taxes. And the reason he's not paying taxes largely is because of what we're talking about here today. Yep. It's depreciation, it's cost segregation, and it's managing and deferring taxes as long as you can. And, even with, if you don't do a 1031 exchange, kind of going back to our example earlier. So let's say you did sell for cash and you're about to pay recapture. Well, now that they've increased this bonus depreciation so large, even if you just go out and reinvest that money in the same tax year and buy a bigger building or another building, you can do cost segregation there.
Yep.
Get the big bonus depreciation and offset the recapture tax. So oftentimes now because of 100% bonus, it's like it almost, you can get to the same place. Whereas before bonus depreciation, it was much harder to offset gains without a 1031 exchange.
Well, I think especially for LPs in a syndication, I think that's where that concept really makes a lot of sense because, LPs, if you're in a real estate syndication, I wouldn't say it never happens, but it's rarer that you're exchanging, right? And you're taking, all those LPs into a different building. These guys want liquidity. They want that money back, and then they're going to go figure out what they want to do with it. But to your point, there is recapture on all of those depreciation benefits that they realize. And those K1s, I mean, they're coming back. Like there's a hotel deal that I'm doing right now in Tampa, and the year one write-off is supposed to be anywhere between 50 to 70% of the investment amount in year one. Yep. So it's like for every 100K, you're writing off 50 to 70K year one. Eventually that's going to get recaptured. But to your point, like if you can go and then take and buy something in that same year, right? Or invest into something as an LP. So how does that work as an LP? Like do the same things apply? Granted, this is not tax advice, everyone. I just want everyone to we're spitballing here.
Sure. Look, I'm not a tax advisor or a CPA, but I could play one on TV for sure because I've been around it so long. But so as a limited partner, in many cases, you would be considered a passive tax investor. That would mean, let's say you have a full-time job as a software engineer or a doctor or whatever, and you're just investing in properties on the side. In that case, when you're getting your depreciation write-offs from your investments, like you said, those are considered passive write-offs, and they can only be used against other passive income. You can't take those deductions and use them against, let's say, the income you're receiving from your medical practice, or if you're a software engineer from that income. And so you would look to, you could get a bunch of deductions there, and you have to kind of plan a little bit better as far as, am I going to have passive income? Well, if you're selling one of your limited property investments, you can, you're going to get a gain that year. What are ways that you can offset that gain so you can eliminate the tax? It's going out and investing in the next property in the same year, getting that 50 to 70% write-off, maybe investing more in that, after that. So you can, if you invest twice as much to completely cover any of the gains. But that's the game that real estate people are paying. Why pay the tax if I could go leverage up, borrow a little more, wipe out the tax, just not pay it, and use that tax savings to literally put into another property that's going to spit off income and grow, appreciate in value, et cetera. And that's the way real estate investors have been getting rich. It's really avoiding paying tax and using that to grow grow their investments even more.
Yeah, 100%. And I think, to kind of speak to the rationale behind these policies, if we could just for a second, I think the rationale behind these policies is to incentivize people to invest into real estate. I mean, the philosophy here is, how do we keep our real estate looking fresh, looking nice, provide good places for people to live? How do we incentivize people to do that? Well, it's through initiatives. It's through tax incentives like this, because otherwise there's there's less incentive. If no one's incentivized to invest in these things, John, why would they do it?
It's definitely, like I said, the tax rules are slanted towards real estate owners, just the way they're written. When we talk about bonus depreciation and accelerated deduction, if you kind of step back, the rules, they're really meant to incentivize all businesses to invest in construction or equipment, right? And so the stuff that, back if we went 50, 60 years, when Congress put this stuff into place, what they wanted is they wanted businesses to invest in equipment, new equipment, go buy new equipment. And, and the stuff that we're talking about inside a building just happens to be defined the same way as essentially equipment is defined for, let's say, a big manufacturer or any other construction company that needs to go buy construction related equipment. It just falls into that same category. And so, the incentive is to invest. It's invest.
Yeah, 100%. You worked, so this is a selfish question, right? You, speaking of like equipment and things like that, right? So you used to do, and I'm not sure if you still do, cost seg studies for casinos.
Well, yeah, my prior life when I got started in the business, I graduated college with an engineering degree from Purdue University.
Nice.
And fell into this world working for a company called Arthur Andersen. At the time, they were one of the biggest accounting firms in the world. And it used to be called the Big Five accounting firms. Now it's the Big Four. But anyway, they did a ton of work for the casinos in Las Vegas. So, I've had experience doing these types of studies really when I got out of college for these major casinos, major pharmaceutical manufacturers that had these huge plants. But the casinos were the fun ones, right? Because we have to go into these massive buildings where they're spending $1 billion, and pretty much like everything you turn around and look at fell into these categories for accelerated depreciation. So, if you think of Caesar's Palace, and you're, all of the decorative stuff to make it look like you're in Rome, the fountains inside the buildings that cost, $200,000, with all the piping and everything in there. And so, I'm going around the whole property trying to put a value to these things because, of course, when the contractor builds it, a lot of times they're not separating everything. And so the casinos are definitely the fun ones, just because obviously they're super ornate. They're spending tons of dollars, and it's really nothing's off limits for what they're spending on.
Does this also include, so obviously you talk like the ornate stuff, this is just for my own curiosity, like what about the tables? What about the slot machines, right? Like, are those things also looped into the study?
It's all considered personal property and equipment, and it gets to be written off quicker. But when you're talking about cost seg for a business like that, they're buying all that stuff separately, and they don't need our help figuring out what to do with that. Where they need our help is, look, we just spent $500,000 on this massive casino. We paid a contractor, and there's, it's just a mess. All the different accounting that went into this massive project, and how do we connect, what we're looking at, this huge overhang outside of the building where the parking valet stand is, and there's huge columns, and it's not separated in any invoice, so we have to essentially come up with the cost by understanding how it was built, measuring what materials were there, and coming up with what we think our professional opinion is of the value for all these different components. That's really where we're bringing the value on those projects.
Yeah, that's fascinating. So I see. So you're basically reverse engineering, right? Like all of the components and things that went into the building, and then putting them into the different buckets, right? That's really interesting. Well, and with situations like that, and you talked about pharmaceuticals and we'll like hotels in there, where there's like that personal property, right? In addition to the real estate and all of the things that go into that, it's really like a double whammy, right? When you think of like say a multifamily building, right? The deductions are far lower, right, in a multifamily building than they are, say, like a hotel or like a casino, something like that, because of the distinction between like hotels and casinos needing all of that personal property, whatever, inside the building to like actually operate the business. Yeah.
Yeah, absolutely. You know, if you're looking at a restaurant, for example, you spend $2 million on a restaurant, you know, maybe 40% of that is going to be carved out because you got so much stuff going on in the back kitchen areas from exhaust hoods, and vent systems and piping and gas stoves and all types of stuff that they need to add to the building. Now, you compare that to maybe a warehouse, right, which is pretty much an empty shell. There's definitely a spectrum of from warehouses all the way to things like casinos, or even data centers, for example, where the amount of costs that would essentially not be considered the structural components of the building can be written off quicker.
Okay, so I'm putting you on the spot, but obviously you can handle it. Data centers is one that I didn't think of. So if we had to loop like bare bones or like real estate that has less, I guess, like depreciation potential overall, right? Or less cost depreciation potential versus real estate that does, what are those two? So in one bucket, we've got, you said warehouses, right? Yeah. What else would kind of fall in that like lower, like bare bones kind of like real estate?
Yeah. And, you know, industrial buildings where there's, you know, office flex kind of spaces. You know, I think just C-class office buildings might have a little bit less on the lower side. On the higher side, you're looking at things like R&D facilities. You're looking at things that we talked about, or restaurants that are super ornate or high end, especially. You know, high end hotels. There's obviously the economy hotels versus the high end hotels. There's going to be a variance there.
Right.
Things like golf courses can actually be great cost segregation candidates, especially.
Really?
Yeah, because the golf course, the tee boxes and the greens themselves can actually be written off right away. Because
really,
you think it's a piece of land, but because there's these drainage systems underneath the tee boxes and greens, the entire cost of those greens and tee boxes essentially are written off right away.
Interesting. Okay. Yeah.
Also, like the other thing, if you're anyone's like looking to figure out how to maximize depreciation, I'd say land improvements is another factor. Okay. So if you bought building A, and building A is 10,000 square feet and it's sitting on top of a 5,000 square foot lot because it's in an urban area, very little land improvements, and, it's sitting on top of a parking garage, that's going to get a much lower reclass percentage of accelerated stuff compared to the same building across the street that's sitting on like a 40,000, 50,000 square foot lot with a huge parking lot and landscaping and, everything else that might be included. So, a lot of that stuff outside the building does kind of play into how much accelerated deductions you get.
Interesting. So why is that?
Just so the way the tax rules are written is that the stuff outside the building, let's say light poles, let's say the concrete walkways, irrigation systems, landscaping, like I said, the asphalt paving, any other type of, fencing around, all of that gets a 15-year tax life guess what? It falls into the bonus depreciation, which means you get to write it all off in year one. So the more of that there is, the better.
I see. That makes sense. That makes a lot of sense, actually. That's very interesting. Coming back, because we spent a lot of time on like the commercial stuff, right? The commercial real estate. Let's come back to the single family, like smaller residential type of real estate. One might ask, well, this sounds like it could really be a good thing for people that, are investing in these like big, massive, hotels and data centers. Like, well, I just have like a $300,000 short-term rental. Why should I consider doing so? Yeah.
And, if you asked me this 10 years ago, I would say you shouldn't, because it's just not going to make sense. Because normally to do a cost seg study, you would have to hire a firm like us with engineers on staff to go out to the facility. And it can cost anywhere from $5,000 to $10,000 on average to do these studies. And yeah, it wouldn't make sense if you bought a property under $500,000, for example, like you're talking about. But back in 2016, we launched a product specifically for the smaller residential investors because we knew that they weren't able to take advantage of this. And so we have software that we call the Residential Cost Segregator, and it's found on costsegregation.com. Okay, it's this software. It only costs $500 to use. And it's a do-it-yourself. It takes less than 15 minutes. And if you're looking at, that $300,000 property that we talked about earlier, you're increasing your deductions by about $45,000. So for $500, if you can use an extra $44,000 of deductions in the current year, it makes it a no-brainer.
Yeah, and that's awesome. And in terms of the benefits there, so as a short-term rental owner, if you have enough of these, right, Gian, you can, and depending on how you should talk to your accountant, you should like make sure that you're doing things the right way. But like once you have like enough of these properties, you can qualify or as a real estate professional, right?
Yeah.
So
yeah.
Talk about that a little bit. Yeah,
sure. Yeah, let's talk about that. So there's two things to understand here when we're talking about qualifying to be able to use these deductions against all your other income. One is the more commonly known qualifying as a real estate professional. To qualify as a real estate professional, it requires 750 hours of time that you're focused on essentially managing properties, investing in them, etc.
Yeah.
However, it's not there. You have to invest 750 hours, and you can't be spending more time on any other business activity. Okay. So if you have a full-time job as a software engineer, spending 2,000 hours a year, even if you spent 750 hours doing real estate, you still wouldn't qualify, right? But if you are considered a real estate professional, any of your investments, you're making money on these real estate investments, you can start netting and grouping everything together, so you can start using your depreciation deductions to manage and offset income when you know it's coming. There's a couple of planning strategies around that. One, a lot of people don't know this, but if you're married, for example, I own a business that does consulting and tax. My wife is a real estate professional, right? And she manages our properties. So she's putting in the hours, right? And if you're married, filing jointly, and you own properties together, we can use those tax deductions from real estate and use them against my income from my business. Okay. And that's strictly because, we're married and we get to net everything together. So, if your spouse is in real estate and, definitely you're earning money elsewhere, very good strategy to start investing in buildings, income producing properties to be able to use those deductions against what I call your active income. Now, if you can't qualify or meet that definition, either of those, there's another strategy related to short-term rentals that I think you're referring to. And you can Google this. Someone at some point coined the term short-term rental loophole. Okay. If you Google that, you'll find a ton of stuff on this short-term rental loophole. And what it is that when you're investing in short-term rentals, again, this is just because of the way the tax code is written, short-term rentals fall into a different category than investing in long-term rentals. Short-term rentals, the IRS looks at more like a hotel, like your business, right?
Yep.
Hotels are short-term rentals. Well, hotels have to be depreciated over 39 years. Guess what? When you buy a short-term rental home for $300,000, it has to be depreciated over 39 years because it falls into that same category as a hotel. But because of that, the material participation rules, the rules that you have to qualify to be considered active income are different. And so if you're in the hotel business, same with short-term rentals, you only need 100 hours of material participation to be considered, for it to be considered active income. It's 100 hours, and nobody else can be spending more time than you managing that property. So, just want to make sure that you want to look at these rules and details. But so now, if you have a couple of properties where you're spending more than 100 hours short-term rentals, much easier to clear that hurdle. And now you can use those deductions against your other income if you're a software engineer or doctor or lawyer, et cetera.
This is what keeps the rich, the rich understand this and they actually do something with it, man. These are strategies that it's surprising how few people actually know and take advantage of these strategies. Like there's some people that do take advantage of them, but still it's crazy that more people don't.
Yeah. Yeah, it is. And it's funny because even some CPAs, the thing is in this country, the tax code is so dang complicated that even most CPAs can't keep up with it, right?
Right.
Like, actually, I don't think any CPAs could truly keep up with it, right?
Yep.
And so when some CPAs hear that strategy that I just talked about, short-term rentals and being able to use it against your other income, some of them, like it doesn't feel right. It doesn't smell right. And they're right. It's like, this is weird. Why would this be allowed? Well, it's one of those things that just the way the tax code is written, if you keep going down into the different kind of regulations and everything that's written about it, and I've done this, that's the conclusion you reach. And it's becoming, like I said, you could Google it. More and more people are talking about it. It's been around for a little while, but still not mainstream.
I would completely agree with you. And that's why I always encourage my listeners and my friends and the investors that I work with. There is a varying degree of competency, a varying degree of competency in the CPA community. There's a lot of CPAs that are honestly not any better than H&R Block. In fact, some of them are worse than H&R Block. It's like you'd be better off going to do it for, using TurboTax than going to these guys. And then there's the people that really approach it and look at the tax code and say, this is the book that's going to show me how to to keep my clients from ever paying tax again. Right. And those are the CPAs that you want to work with. And not only that, but the CPAs that really and truly understand real estate tax strategy, because that's a big one, right? Like some of these guys are good, but they don't really understand real estate. And when you find an accountant that understands real estate, understands the tax code, and shares that mentality of like, this is the book that's going to show me how to help my clients avoid paying taxes. Those people you want to latch your wagon to and ride with. So, John, this has been awesome, man. We've covered a lot here. Before we kind of go into the last section here, you mentioned before we got on, obviously costsegregation.com. There's a promo code for the listeners if they're interested.
Yeah. So like I said, that software is for property owners, any property that's 6 units or less. It's at www.costsegregation.com. And your listeners are going to get a 10% discount for first-time users. And the promo code for that is GOLDMINE2025. That's your last name, GOULDMINE 2025, all caps. Okay. Like I said, it's $500 to use. They'll get a 10% discount, and that's GOLDMINE 2025, capital GOULDMINE 2025.
Awesome, man. We'll have all that in the show notes as well. An homage to the podcast, the podcast name. So that's awesome, man. Well, listen, we've covered a lot right now, and I'm trying to figure out because I actually have a lot more questions for you that I wrote down. I'm like, I need to end with a good one here before we roll into the last part here. Let's talk about the energy tax credits. So you mentioned energy tax credits. Tell me a little bit more about that.
Yeah. So there are some energy tax incentives right now in place for real estate owners. Typically, you have to be buying or constructing some, I'd say, more substantial property. So spending $5+ million constructing or renovating. And if you're a multifamily developer, there's a credit in place right now. It's called the Code Section 45L tax credit. It's worth up to $5,000 per unit. So if you're building 100 units, that could be $500,000 of tax credits. It has to be energy efficient. Okay. Now, here's the catch. The bill that was just passed 2 months ago essentially is repealing that. And so the timeline right now for that incentive is the property has to be placed in service before June 30th of 2026. So that one's going to go away. Then there's another incentive for commercial building owners, and it's worth about $5 per square foot of building, and it's a deduction. So if you bought, or let's say you built or renovated a 100,000 square foot warehouse, the deduction could be worth up to $500,000. If it's energy efficient, again, requires a third party like us to come in and certify the energy efficiency. And again, that one also got repealed 2 months ago. But there's a little bit of a better timeline on that. So as long as construction on your property starts before June 30th of 2026, you can still qualify for that. So that's another one to take a look at. Also, other things inside the building. Obviously, if you're putting solar on the building, things like geothermal heat pumps, anything that is related to renewable energy components, it can qualify for a tax credit. And when we're doing our cost seg studies, sometimes we identify these things in the building and essentially get tax credits for the owner. That also is getting repealed. So this is. I know we talked about all these credits, these green credits. They were the losers in this tax bill, unfortunately. But Danny, what I'll say right now is, by the time we get another president, you never know. This stuff goes and it comes back, and it goes and comes back. But right now, that's that's where that stands.
And I think that's why it's so important to have experts, right? And why it's important to hire experts, whether it's, from an accountant standpoint or from a cost seg standpoint, right? Like having somebody that really understands how things work today, right? Because to your point, this same time last year, we weren't talking about 100% bonus depreciation. We were like, it's like 60, now it's 40, now it's 20, like there's a step down every year. And understanding the complexities of that role, I mean, people were so confused, right? And so if you're not really on top of it, then you got to hire an expert that is to make sure that you're being guided and given the right advice for the year that we're in. Because this advice that we've talked about today, it's not even advice, but you know what I mean. The things that we've talked about today, these are material facts for 2025. No guarantee that in 2030 that these things are still true. Well, maybe the skeleton, right? The bones might be true. That there could be some intricacies there or different things that change right over the years. But Gian, this has been great, man. In traditional fashion, though, before we let you go, before we let you leave the vault, you got to leave us with one final secret, man. Take it away.
Oh boy, you didn't tell me this was coming.
Yeah.
Geez, I don't know if it's a secret or not. Hey, I'm in LA, and I'm a huge Boston Celtics fan, which I don't like to tell too many people here in LA.
Don't say it too loud. Yeah.
Right. No, I don't know if that qualifies for a deep secret or not, but yeah, that's what popped up.
That's funny, man. Yeah, you're living in Cali, but you're a Celtics fan. All right, well, that's hilarious. No, this has been you've been a wealth of knowledge, Gian, and really appreciate you stopping by. And who knows, maybe we'll have you on again, and we can dig a little bit deeper. But for now, it's been a pleasure, my friend.
Thank you, Danny.
All right.